The entire global financial system, we're talking trillions of dollars flying around the world every single day. It all runs on mathematical models. They're like these invisible engines, forecasting risk, guiding investments. But what happens when those models, the very bedrock of modern finance, are built on a fundamentally flawed view of reality? To really get that, we need to go back and look at the story of financial risk itself. So here's what we're going to dive into. We'll start with how this all began, with the classic daily risk report. Then we'll see exactly where the core assumptions of those reports just completely break down. After that, we'll look at the dangerous real-world consequences. And finally, explore how a new technology, automated machine learning, is forging a new partnership between smart people and even smarter tools.
So our story starts with a simple yet incredibly powerful demand from the very top of one of the world's biggest banks. A demand that would pretty much change finance forever.
As the legend goes, the chairman of J.P. Morgan had this request. It led to what's now famously known as the 415 report. See, he didn't want a 100-page binder full of complex math. He wanted a single daily number that basically answered one question: how bad could things get tomorrow? And that simple demand, it kicked off a revolution in how banks manage risk. The solution they came up with was a metric called Value-at-Risk, or VAR for short. The easiest way to think about it is like a daily weather forecast, but for a bank's money. It tries to answer a very specific question. With, say, 99% confidence, what's the absolute most money we can expect to lose in the next 24 hours? And you can see why this became so popular, right? All of a sudden, the massive, chaotic, complex world of a global trading operation could be boiled down to one single, easy-to-understand number. It was powerful, it was elegant, and it very quickly became the gold standard for managing risk across the entire financial industry. But, and this is a huge but, hidden inside that elegant little number was one single gigantic assumption, an assumption about how the world works that would, well, turn out to be dangerously wrong. Okay, so here is the crucial flaw. These VAR models are built on the idea that financial returns follow a perfect, predictable bell curve. You've probably seen one before. Mathematicians call it a normal distribution. In this neat and tidy world, small ups and downs are super common, and huge catastrophic events are so rare that they're basically considered impossible. Now, you might be asking, why on earth would they make such a big assumption? Well, for starters, it makes the math way, way easier to handle. You only need two simple inputs. And honestly, when markets are calm and stable, it actually works pretty well. It kind of imposes this comforting sense of order on a system that's naturally chaotic. But here's the thing. The real world is not a perfect bell curve, not even close. It's a world of what analysts call fat tails. This means those supposedly impossible events out in the tails of the curve, they happen a whole lot more often than the models predict. And that is the core of the problem. Assuming everything is normal leads to a massive underestimation of risk. This quote just says it all, doesn't it? The very foundation of these traditional risk models is a picture of the world that just doesn't line up with what actually happens. And when that mismatch occurs, the consequences can be, well, disastrous. So, we've covered the theory. Now let's see what happens when this theoretical flaw crashes head-on into the real world with some very, very expensive consequences. And in 2012, this is exactly what went down. A gigantic multi-billion-dollar trading loss at J.P. Morgan. Yep, the same bank that pioneered VAR sent absolute shockwaves through the industry. All of a sudden, this idea of model risk, the risk that your models themselves are the problem, was front-page news. This quote really breaks down the danger so clearly. A trader could be following the rules perfectly, right? Keeping their 99% value-at-risk number under a $10 million limit. But the model tells you nothing about that other 1% of the time. On that one day out of 100, the loss could be 50 times the limit. The model creates this enormous blind spot. And it wasn't just J.P. Morgan struggling with this. Over at Goldman Sachs, they've long had a, let's call it a more skeptical philosophy about the limits of any financial model. And their view gives us some crucial wisdom. First, even the best model is just that, a model. It's not reality, it's a simplification. Second, models find correlations, which isn't the same as finding the actual cause. And maybe most important, the person building the model has to have deep, intimate knowledge of the thing they're modeling. Just relying on the math alone is a total recipe for failure. So the problem is pretty clear. Traditional, theory-driven models just can't keep up with the messy reality of the market.
And this is where a brand new, data-driven approach starts to enter the picture. Let's just look at the difference here. Traditional modeling starts with a theory, like the bell curve, and then it tries to jam the data into that shape. Automated machine learning, or AutoML, completely flips that script. It starts with the raw data itself, and then uses powerful algorithms to find the real patterns and relationships hiding inside, without forcing any preconceived ideas onto it. And I know machine learning can sound really intimidating, but this quote from JP Morgan makes a super important point. These aren't some kind of magic black boxes. Really, they're just powerful evolutions of the same statistical tools banks have been using for decades, just, supercharged by modern computers and enormous amounts of data. Let's look at our real-world example, trying to predict which mortgages are likely to default. If you just guess randomly, it's a coin flip, 50-50. But an AI model can sift through thousands of data points, finding these subtle patterns that a human expert might totally miss. And the result is a system that is just significantly better at spotting those hidden risks before they blow up. So, does all this mean the machines just take over? Not at all. The future of finance isn't about replacing the human experts. It's about giving them much, much better tools. This quote from Jamie Dimon, which came right after that huge 2012 loss, is absolutely key. Even the most sophisticated, data-driven model you can imagine is still built on historical data. It analyzes what's already happened, but it can't perfectly predict a future that is, by its very nature, uncertain and totally different from the past. And this leads us to this new idea, augmented intelligence. It's not about artificial intelligence replacing human intelligence. It's about combining the two. It's all about smart minds smartly using smart tools. The idea is you let the AI do the heavy lifting, the massive data analysis to find the patterns, and then you let the human experts use their experience, their intuition, and their real-world knowledge to interpret those results and make the final call. So let's just quickly recap the crucial points here. First, we saw that the old-school financial models assumed a normal world, but reality is full of wild surprises. Second, that mismatch, what we call model risk, can cause billions in losses. Third, new tools like automated machine learning are flipping the script by learning straight from the data, not from a theory. And finally, the ultimate goal here isn't to replace people, but to create this really powerful partnership between human expertise and machine intelligence. And this leaves us with one last big thought to chew on. We are getting so much better at building tools to manage the risks we know about, to see those fat tails in our data. But the greatest risks are often the ones we've never seen before. So the real question becomes, how do we prepare ourselves for the risks we can't even imagine yet?